My personal investment strategy right now is that I think silver could easily go to $100, $200 for the next year or so. I'm serious. And gold go a lot higher as well, of course, but silver outpaced gold. But in this particular surge that I think we're on the cusp of triggering, like I said, get up to that 34.90 on momentum, it's going to break out. You get up to 35, you're back to a triple top. It's a hand of top. Silver never tops, even with double tops, much less triple tops. That's a launch pad. But when you go through that level and touch 36 for all the price chart guys, they know they got a breakout then. I think that next move will likely carry you up into the 60s to 70s zone. I'm not going to be any more precise than that. But I think $50 won't even be a pause point.
Silver's relative underperformance compared to gold in recent months draws significant attention from market analysts, especially as the white metal trades within a tight, indecisive range. While gold reached record highs earlier this year, silver has remained subdued, drifting sideways for weeks, reflecting a combination of investor hesitation and perhaps strategic accumulation by those anticipating a future move. The gold-to-silver ratio, which remains near historical extremes, clearly underscores that silver is still fundamentally undervalued relative to its more established precious metal counterpart. Michael Oliver emphasizes that these momentum divergences often signal an important buildup phase before silver makes a strong and decisive upward move, suggesting that patience may soon be rewarded. Looking back at history, such divergence between the two metals often serves as a reliable indicator of silver's most powerful periods of outperformance. During the 1970s and early 2000s, gold consistently led the initial breakout, followed by a sharp correction, after which silver accelerated at a much faster pace. For example, in the 1970s, the gold-to-silver ratio compressed dramatically as silver surged from under $2 per ounce to an astonishing $50 within less than a decade, capturing the attention of investors worldwide. A similar pattern played out after gold surpassed the $300 mark in 2003, when silver went on to climb more than 800% by 2011. These historical cycles demonstrate that silver tends to lag at first, quietly building strength throughout gold's rally before breaking out with significant upside momentum once key technical and psychological thresholds are crossed. Michael Oliver highlights the $35 level as a critically important technical milestone in silver's ongoing market cycle. According to his analysis, this price point has consistently acted as a formidable resistance zone since 2011 and 2012, effectively forming the upper boundary of a long-term consolidation range that has persisted for nearly a decade. Oliver stresses that a sustained monthly or quarterly close above $35 would not only mark the second highest closing price in silver's modern trading history, but also signal the removal of the final significant hurdle before silver can realistically target its historic all-time high near $50. Now, we present the clips from Michael Oliver's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
First off, the silver versus gold situation is, I think, essentially that chart too, going back about 50 years. If every year you made a note of what was the highest spread reading of silver versus gold, and the way we define the spread is we simply divide silver price into an ounce of gold price, and we get a percent. And you'll find over the last 50 plus years that 21 of those 50 years, silver's at least at some point during the year traded 2% of the price of gold. Well, right now we're 1.01% the price of gold. So historically, we're very low. We've been lower, but this is very low for silver in relation to gold. Everybody knows that. Okay. When we technically analyze whether there's the potential to go back up to that, even just the normal 2%. It's not even asking a lot. You're asking for routine recovery to a normal level. Well, that's a doubling in the current valuation of silver to gold. Are there technicals that indicate to us that spread, analyzing the spread technically, is ready for an upturn and a surge? And we see them. We've not broken through them yet. Right now, silver, like I said, is 1.01. Divide an ounce into an ounce, as of today, as we're talking. Okay. If you get up to 1.1%, the price of gold, so move up 0.1%. Okay. That spread is going to break out on our work over a first level of breakout. And if you ever clear 1.32%, you can make a note of this if you want, 1.32, I think you'll gush up to 2%, meaning just go to the norm. Well, heck, that process involves the doubling of current valuation of silver to gold. Now, whenever silver outperforms gold, it's never in a downtrend on both markets. In other words, when silver outperforms gold, it's because it's going up more than gold. It's never the case that silver outperforms gold because gold goes down more. You know what I mean? So the spread breaking out to the upside is also affirming net price upside in both markets. And I think we're on the cusp of that. And I also sent you a chart of the gold and silver miners versus gold. And that is a very clear spread chart. It goes back to 2020. And why did I go back there? Well, if you'll recall, that surge that occurred from late 2019 to 2020 was not only a price surge for all the metals and the miners, but it was a relative performance surge by the miners where miners beat the pants off gold during that 6 or so months of that surge into mid-2020. Well, if you go to the peak of that rally, which is what this spread chart shows, you'll see it's a staircasing decline in the relative performance of the gold miners versus gold. There's a structure on that chart, if you treated it as a price chart, which in effect it is, it's price versus price. There's a downtrend structure and there's a horizontal structure, such that right now you're nudging up toward that level. In fact, that chart is as of last week's close. You're stronger than what that chart shows. You're not at the breakout level, but that breakout level is so well definable that when you break through it, expect miners to gush on the upside, not just in price, but in relative to the gold market, which they often do in bull trends, particularly later in bull trends. So we see both silver and the miners, which have been underperforming gold for the last several years in particular, since that 2020, 2021 period, they look ripe to turn up versus gold. And then there's a net price issue on silver too. And you mentioned that. I had a long-term oscillator that I showed. It's a 40-week average oscillator. Now, what is that? That means each week we take the weekly range and we plot it on an oscillator versus where is the 40-week average. 40-week average is about like a three-quarter average. It's about the same duration as a 200-day average. So it's a long-term average. And we want to know where is this week's range in its relationship to that average. Is it above it or below it? In which case we plot the oscillator. That oscillator has a parallel channel on it that goes back to last May. And if you close this week out, and right now as we're talking, silver's been up to upper 33s. You get to the upper 34s, like 34.90 area again. Remember, it's peaked twice above 35, October of last year and March of this year. You get back up to the high 34s again, that spread's going to, not the spread, that momentum chart's going to break out. Meaning momentum says, I'm going for it. Meaning go for what? A triple top breakout in price. And I'm sure that whenever you go to 36, the price chart guys are going to say, well, I guess we were wrong. It's not a top. That's a triple top breakout. 235 peaks, you go to 36. The point and figure guys will get all excited. I think it's going to happen. I think this rally is for real. You add $1 to about where today's high is, and it is for real. We're going to surge. And that's a net price acceleration sign for silver, which I bet will correspond to a relative performance shift by silver as well. I think silver is going to blow the hell out of those two highs. First off, like you said, they're irrelevant, really. They're nominal price highs. They were exceptionally brief. If you go back and look at them, there's like thin air. They were up there for a couple of days, and then they dropped hard. So it really isn't like an overhead ceiling. It was an exhaustion. We're in a different world now, fundamentally and technically. And to reference those old highs as some kind of level to clear, fine, if you want to do that, do it. My personal investment strategy right now is that I think silver could easily go to $100, $200 for the next year or so. I'm serious. And gold go a lot higher as well, of course, but silver outpaced gold. But in this particular surge that I think we're on the cusp of triggering, like I said, get up to that 34.90 on momentum, it's going to break out. And you get up to 35, you're back to a triple top. It's ain't a top. Silver never tops, even with double tops, much less triple tops. That's a launch pad. But when you go through that level, and touch 36 for all the price chart guys. They know they got a breakout then. I think that next move will likely carry you up into the 60s to 70 zone. I'm not going to be any more precise than that. But I think $50 won't even be a pause point. In other words, I think you're going to get a quantum leap here up out of this history of silver. And in other words, put it somewhere remotely where gold is. Gold's peak in 1980 was $850. Its peak in 2011 was $1,920. Okay, well, gold's gone way beyond those old highs, and silver's still capped below them. That's a joke. I don't reference those old highs as meaningful. It's a number that I suspect that when you take it out, a lot of people will say, gee, I better own some silver. Okay. And frankly, once they gush it for about 10 or 15 bucks, I might take some call profits. But that's what I think is likely to occur over the next handful of months, maybe a quarter or two.
In 2024, the silver market experienced a deficit for the fourth consecutive year, a clear indication of persistent tension between supply and demand dynamics. Although the total silver supply increased slightly by about 2%, demand fell by approximately 3%, resulting in a significant shortfall of around 150 million ounces, or 4,600 tons. This ongoing imbalance highlights fundamental pressures that typically encourage upward price movement. However, despite these conditions, silver has not yet experienced the expected rally relative to gold, with many investors, including Michael, waiting for a stronger breakout that has yet to materialize. This disconnect between market fundamentals and price action suggests that other factors may be influencing silver's performance in the short term. Throughout 2024, the gold-to-silver ratio fluctuated within the range of 80-1 to 90-1, signaling that silver's price gains have lagged behind those of gold, its more stable precious metal counterpart. Even so, the persistent supply deficit paints a picture of a market with strong underlying fundamentals. Industrial demand, driven by growing sectors like solar technology and electric vehicles, combined with steady investment interest, continues to exert upward pressure on silver's value. As these supply constraints endure and demand recovers or grows, the groundwork is laid for silver to potentially break out and narrow the gap with gold. Moving forward, these tightening fundamentals suggest that silver could see renewed price strength, possibly ushering in a period where it reclaims more attention from investors seeking both industrial utility and monetary value.
No, I'm not watching them. I do realize that, but as you said, it's been true for 5 years. Okay. Well, I guess for the last 5 years, silver's risen. Okay. If you stand back and look at it. But no, I think that there's other factors. Yes, I think the industrial demand for silver is a pinch factor, and it could be a headline event type thing. And we know it's now shifted to solar panels, the cells that operate. And therefore that demand is pretty solid and it's growing annually. And therefore silver's, got that game in hand, and people haven't paid that much attention to it. And there's some point where that could create a supply pinch that gets a headline type story, that motivates a surge, for example, like the surge I just talked about. Maybe somewhere in the midst of that's going to be a focal point. But it's always been there, as you've said. It's been there for a couple of years now. So I don't think it's a timing thing. It's just a background feature that's objective and it's real. I think the real thing that's going to drive silver is that it, just like gold, has been money for thousands of years. Okay, so you don't just say, oh, well, it's not money anymore. Well, the world doesn't know that. Okay, we might think that, but I think that it's not the case. There's a large assumption, for instance, back in that April sell-off in silver where gold had a single % drop when the stock market collapsed. And everybody said, oh, we got to sell silver because the stock market's breaking. And so they sold it just like they did, let's say, copper or the Bloomberg at the same time. They treated silver not like gold. There was no comparison. Silver's collapse was huge. It went from $35 to $27.5, most of that in 2.5 trading days, by the way. And about 2 days later, you'd erased half of that loss and you're back above 30 again. But that kind of collapse, there's an assumption that silver is connected to commodities. But if you go back historically, silver is connected trend-wise to gold. And often the commodity complex does not trend with gold. It did in the late 70s. I think it's about to do it again. But for example, if you go back to 2015, when gold and silver made a low, major low, and it advanced, the Bloomberg hit a low, but it kept going down through 2020. Bloomberg Commodity Index. It didn't collapse, it just kept going down. All during that time, gold doubled and silver exploded, and yet commodities went down. So don't make the error of trying to confuse the industrial aspect of silver with a normal commodity. It is a monetary metal, and it will catch up to gold.
The combination of growing monetary and industrial demand alongside supply constraints creates an exceptionally strong foundation for silver's outlook. Current macroeconomic conditions are aligning these factors, helping to explain the positive technical trends emerging in both silver and silver mining stocks. As Jordan Royburn highlights, the perfect storm for silver involves negative real interest rates, expanding industrial uses, and mining supply limitations, all of which are becoming increasingly evident today. Silver's role in green technologies such as solar panels, electric vehicles, and antimicrobial applications is expanding rapidly, driving sustained demand even amid economic fluctuations. This growing industrial consumption, coupled with heightened investment interest, raises the possibility of a silver market squeeze that could push prices sharply higher. When considered alongside ongoing strength in gold, the outlook for precious metals appears robust, suggesting that silver is well positioned for continued gains in the near to medium term. That's it for today. Share your thoughts on Michael's analysis of the silver price breakout in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.